So this is essentially how this most recent interest rate cut is going to impact your mortgage renewal and what might be to come in future months if inflation remains on target. Hey, what's going on everyone? It's Griffin here, and in today's video I wanted to speak about last week's interest rate cut by the Bank of Canada to cover what this recent cut means really for everyday Canadians, along with what I believe this will mean for the broader Canadian economy moving forward. The bottom line though is that the Bank of Canada has chosen to cut interest rates at a time when inflation has dropped quite significantly from recent highs, having come in at 2.7% in June of this year, which is quite the progress from where we were 2 years ago. But nonetheless, this also signals that the Bank of Canada is recognizing the Canadian economy's weak performance and projected growth over the next several years. Now, although the Bank of Canada is tying this rate cut to inflation targets, well, I've been saying for over a year now on the channel that I believe the Bank of Canada would start slashing down rates as of mid-2024. So hey, we're right on cue, of course, and this is in part due to the fact that millions of Canadians have mortgage renewals in late 2024 through to early 2026. And in the face of a Canadian economy that's already hurting quite badly, as we covered in a recent video, well, doubling mortgage payments on a wide scale would be catastrophic for household budgets and even worse for Canada's GDP overall. And regardless of what's claimed by the Canadian government and Bank of Canada in regards to how housing should or should not be treated as an investment and a retirement plan, well, the reality is that housing values have skyrocketed over the past couple of years and will remain high due to immigration policies and really just a lack of supply, among other factors. And housing is Canada's largest store of wealth and retirement funding for millions of Canadians, along with being one of the backbones of this country's financial system. So wide-scale mortgage strain and even defaults would really wreak havoc on Canada's economy, which is something that the Bank of Canada most definitely wants to avoid at all costs. And speaking of the Canadian economy, well, we shouldn't be fooled by recent quarter growth figures, where GDP has expanded by roughly 1.75% in Q1 2024, but this is almost entirely driven by population growth on a nominal basis, where, of course, with more people in the economy, well, total GDP might be rising, but when we look at GDP per capita figures, Canada has been greatly struggling over several years, actually. And looking forward, the Bank of Canada's 2.1 and 2.4% growth projections for 2025 and 2026 are also almost entirely driven by that same population growth, which is in part one of the reasons why Canada is having these other issues like housing in the first place. So we've really put ourselves in a catch-22 situation here. Lendlord's been a sponsor on this channel for a while now, and it's for good reason, as their platform is a great all-in-one tool for new real estate investors looking to analyze their first deals or seasoned investors who manage a large portfolio. There's value for all real estate investors. And today I'd like to specifically highlight 3 features that Lendlord offers in their platform, starting with the Deal Analyzer, which allows you to skip the Excel spreadsheets and quickly analyze the potential return of a rental property based on dozens of different criteria and metrics, making the process simpler and just more streamlined while allowing you to gain a visual representation of what returns you could expect from a specific deal. The second feature I'm excited to share is called Search Criteria, and this essentially allows you to input specific parameters for the types of deals that you're interested in purchasing in your area, where you'll receive notifications when properties matching your criteria hit the MLS or undergo price changes. So this feature is incredibly valuable for investors at any skill level, ensuring you never miss out on a potential opportunity. And finally, Lendlord's Wealth Tracker is an easy way to keep track of your net worth stemming from multiple different types of assets above just your real estate that will most likely be tracked in Lendlord anyways. So you can easily add properties, cash holdings, paper assets, and other other valuable goods contributing to your net worth, allowing you to keep a watch on where your net worth is concentrated and how it's growing over time. So if you're looking to get an edge on your property analysis while also thoroughly tracking the progress of your portfolio, make sure to check out Lendlord using my link down below in this video's description, which will allow you to get 3 months of their premium membership completely for free. So please make sure to check that link out down below. It also really helps support the channel just by checking it out and signing up for free. All right, so the Bank of Canada has now lowered its policy interest rate for the second time in a row and indicated that more reductions may follow if inflation keeps decreasing. So it's safe to say that the Bank of Canada is now very much in a mindset geared towards bringing rates back down to help borrowers while also hopefully stimulating the economy once again as money becomes cheaper to borrow. And the 25 basis point cut has now reduced the overnight rate to 4.5%, which is a level last seen in June 2023. So basically a year ago. And this is after the previous month's cut, bringing the rate from 5 to 4.75%, which was the first reduction that we had seen in over 4 years. Additionally, Tiff Macklem, the Bank of Canada's governor, has claimed the following, that looking ahead, we expect inflation to moderate further, though progress over the next year will likely be uneven, and that if inflation continues to ease broadly in line with their forecasts, it is reasonable to expect further cuts in policy interest rates. The timing will depend on how we see these opposing factors place out. Now, in its monetary policy report, the Bank of Canada also expressed concerns that higher shelter costs driven by rent and mortgage interest, as well as services closely tied to wages like restaurants and personal care, are what are essentially keeping inflation more elevated. And I mean, yeah, it doesn't take a rocket scientist here to see that, of course, this is one of Canada's inflation drivers, with rent having increased roughly 7% over the past year in most markets, with a one-bedroom now averaging out across the country at just under $2,200 in June of 2024, because vacancy rates are so low across the country. And yeah, those higher borrowing costs, especially on variable rate mortgages, have skyrocketed monthly payments to the point where many people are up to here in mortgage payments. Now, although the report does lack detailed specifics, it did warn that housing market imbalances will likely continue to exert upwards pressure on inflation for most of the forecasted period, which also isn't surprising in my opinion, as Canada is nowhere near the yearly supply goals that it would need to stabilize housing and rent prices, let alone actually starting to decrease them. Bottom line though, I think it's very safe to say that we'll continue seeing some rate cuts in the future meetings through to the end of 2024, as there are still 3 more interest rate decisions that are going to be made in the last part of 2024, with the next one scheduled to be in September. Okay, now although not a huge game changer, last Wednesday's interest rate cut is still positive news for current and upcoming borrowers and many homeowners as well who have variable rate mortgages. In fact, on average, through a 25 basis point reduction, a homeowner with a variable rate mortgage right now in Canada can expect to save roughly $15 per $100,000 in monthly mortgage payments per month. So let's say on a $500,000 mortgage balance, you'd be looking at some minimal savings around $100, which is still a decent step in the right direction, although many borrowers who have had a variable rate mortgage over the past couple of years, well, they've had their payments hit that trigger rate, essentially meaning that each month they're negative on capital repayment because the interest surpassed the total payment, thus swelling the actual total outstanding loan, which isn't a pretty sight and would need to be refinanced when that mortgage term ends up coming up. That being said, I still think that this rate cut is unlikely to significantly boost housing market activity on a wider scale, as it's really not going to move the needle enough for buyers to jump in while prices are still high. I think a lot of buyers will continue to wait for more rate cuts by at least another 25, but probably more 50 basis points before entering the game once again. And at that point, potentially sparking higher demand though, once again, which would somewhat put us back into a situation of higher demand and we still don't have much supply. What is for sure though, is that if you have a mortgage renewal in 2025, you're definitely going to be faced with a much lower interest rate at signing than where rates have been over the past year, 2 years. So that's definitely a positive to be able to maintain your property if you're scared that your payments would be extremely high due to currently high interest rates. And I don't think we'll be seeing any type of widespread defaulting like so many have claimed. We may see a bit of an uptake, but nothing major. And if you're currently looking to buy a house, it might be worth it to either lock in a 1-year fixed term or even considering variable, banking on the fact that rates should continue to drop. But that's ultimately your decision to make. All right, so that's really just it. I wanted to make an update for all of you on the interest rate cut and what I believe the future holds for the next interest rate decisions in 2024.